Welcome to RBC's Markets in Motion podcast, recorded March 17th, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, we've lowered our year-end 2025 S&P 500 price target to 6,200 from 6,600. Second, we've lowered our 2025 S&P 500 EPS forecast to 264 from 271. Among other adjustments, our new price target and earnings forecast embed the updated views of our economic and rate strategy team released last week. Third, we've updated our year-end 2025 bear case for the S&P 500, which we've lowered from 5775 to 5550. And fourth, we run through the latest developments on the different categories of vibes we've been tracking, which generally continued to deteriorate in last week's updates. A few are starting to look extreme to us, but others have more room to go lower. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number one. We've lowered our year-end 2025 S&P 500 price target to 6,200 from 6,600. That's a cut of 6%. Among other adjustments, the new target embeds the updated views of our econ and rate strategy teams, which were released last week for stickier inflation, real GDP in 2025 of 1.6%, down from 2%, and 10-year yields that move lower from here and then end the year around 4.2%. 6,200 is the median of 5 models that we use to come up with the forecast. There's a wide range of outputs in our modeling, around 5,600 to 6,500, highlighting the high degree of uncertainty in the stock market at the moment. Our sentiment model is one of the two that spits out a projection right in line with the new target price. It's sending a contrarian buy signal right now. AAII net bulls are more than 2 standard deviations below the long-term average, a level that typically sees the S&P rise by more than 10% over the next 9 months. By contrast, our GDP model is producing the most pessimistic output. When real GDP is in the 1% to 2% range, as our economists now anticipate, the S&P has typically fallen more than 3% on an annual basis, which would take the index a bit above 5,600. Our trailing PE model, which bakes in house views on inflation, the 10-year, and the Fed, also projects the index to end the year at a 21.8 trailing PE, or around 57.50 when we bake in our earnings number. Like our GDP models, that's on the more pessimistic end of our modeling. Moving on to takeaway number 2. We've lowered our 2025 S&P 500 EPS forecast to 264 from 271. That's a cut of 2.5%. The bottom-up consensus for earnings was still around 271 as of Friday. We anticipate downward revisions are on the way. Right now, the rate of upward revisions in the S&P 500 is about 42%, and company commentary suggests many, though not all, are not baking in anything on tariffs. Our earnings model is a top-down income statement that relies heavily on macro forecasts, and we've baked into the new house views on the economy, inflation, and rates there as well. We've also lowered our margin assumptions for 2025, taking them from modest expansion to flat. Interest expense is coming down in our modeling in 2025 versus 2024 due to the lower 10-year yield and improvement on the Fed funds versus last year. And that helps the earnings number, but not enough to offset the softer GDP and margin assumptions. Next up, takeaway number 3. We have updated our year-end 2025 bear case for the S&P 500, which we've lowered from 5775 to 5550. Our 6,200 price target assumes the S&P won't go too much lower than where it closed at the low point last week, and we acknowledge that that's not a terribly high conviction view. And so we've been tracking a bear case closely, which essentially is a shadow target if the recent lows don't hold and the stock market experiences a growth scare, which we define as a pullback in the 14 to 20% range, similar to the drawdowns of 2010, 2011, 2015, 16, and 2018 around the European debt crisis, the U.S. downgrade, the industrial recession, and the first China trade war. In our bear case analysis, we take 4 of the models that we use in the price target process and bake in assumptions that are worse than what we've got in the base case. We'll wrap up with takeaway number 4. We run through the latest developments on the different categories of vibes that we've been tracking. We generally continue to see evidence of deterioration. A few are starting to look too extreme to us in terms of their negativity, but others do admittedly have more room to fall. In terms of investor vibes, as noted earlier, AAII net bulls, a gauge of retail investor sentiment, is back to financial crisis lows, but it can admittedly get stuck at those kinds of deeply bearish levels. On the institutional side, CFTC asset manager positioning in U.S. equity futures is early innings in terms of coming down. The options market indicators we track are also showing signs of rising angst with an elevated VIX, but a lack of real fear with a subdued TDEX. On consumer buys, the Michigan survey was weak again last week across all cohorts. What we're starting to notice, though, is that headline sentiment is getting close to historical lows and recession-type levels. On small business vibes, NFIB reported slippage in optimism and optimism on the economy specifically in their update last week. Both of those indicators have been around all-time highs. But NFIB also reported an increase in uncertainty, which is now nearly back to all-time highs, with CapEx and employment expectations softening. On corporate vibes, sentiment in the Business Roundtable survey fell slightly last week, with CapEx and hiring plans softening a bit here as well. And wrapping up with the political vibes, Trump's net job approval has turned slightly negative, while his net favorability remains in slightly negative territory. We have been keeping a close eye on trends in the latter, as that data set has become aligned with S&P 500 price action in recent months. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.